So if you're not yet profitable as a trader, watch this video all the way through. And I don't care what strategy you're trading per se, this applies to everyone. And spoiler alert, it's not going to be the cliche, journal more, be patient more, bullshit Twitter advice, because that stuff makes me sick to my stomach. But I will share, I think it's about 6 real things that I put down here that I narrowed down that, okay, these are the things that stopped me from sitting there spinning my wheels, losing money, to actually pulling out payouts consistently. I've been trading for 7 years, profitable for 3 years. I've been funded for years in multiple places. I take regular payouts as well as post my trades almost daily. So this video is for the version of me who was grinding, who was losing, who was frustrated with the process of learning to trade and trying to make money consistently and unsure why nothing was really working. This is for you. So here are again, about 6 things, the 6 shifts I made to actually start making this work consistently, right? And there's 2 bananas here to cover up about 6 points, and I'm about to give you a DP of knowledge. So pay attention. So the first thing is to take a much shorter term outlook. So what do I mean by this? Well, a shorter term outlook on the market. I'll tell you what was the key turning point in my trading career was when I stopped demonizing scalping and started to embrace scalping and throw that other shit out the window. I do swing trading still to this day. I will take more position moves to this day, but you know what pays the majority of the bills when it comes to trading for me is scalping, base hits. When I stopped trying to catch the big moves, trying to catch the trend, trying to catch the big wave, and instead just focused on A+ setups that played out quickly, where I'm, in the market and out of the market at most. I think my average trade time at the moment is about 8 minutes. I'm in and out of the market real quick, and then I call it a day. And you'll find that a lot of the time, scalping is demonized in the online trading world. Scalping is demonized by retail traders. They think scalping is a losing game. They say, get off the 1-minute chart, start to take a bigger picture view. Why? Why would you do that? For me, the analogy I always use is if you're reading Harry Potter for the first time. Harry Potter's a thick book, at least for someone like me. If you're reading Harry Potter and you've never read it before, you open that first page and you start to read. What can you predict more accurately? The end of the current sentence you're reading, or the end of the chapter, or the end of the book, or even the end of the page? What can you predict more accurately? The end of the first sentence. And the reason is because you can already see the context. There's not a large time horizon for the eventual outcome of what you're trying to predict. And based on the information you can see in that sentence, you need less information to predict the end of what that sentence is going to be. I hope that makes sense. And that same analogy is what I apply to the markets. I can more accurately predict where the market will be in the next, say, 1 to 8 minutes than I can predict where it's going to be in the next 5 minutes, 10 minutes, 50 minutes, 1 hour, 1 day. As soon as you start to expand that time horizon, your chances of being able to predict where the market's going to go just dramatically drops off. So by focusing on a shorter term outlook on the market and trade setups, that gives me less exposure to risk, which gives me less stress, allows me to make better decisions, and I can get in and out of the market quicker. And it doesn't mean you have to make less money. Of course, the beautiful thing about trading is you can size your position up. No matter what you're doing, the same setup, you can take that same setup, scale it up, and what's initially a $200 trade can be the same setup next time, but if you increase that leverage, it can be a $2,000 trade. You know what I mean? So just because it's a smaller move, it doesn't mean you're making less money. So why not focus on what can be more accurately predicted in the short term versus something that's further out and harder to predict? And following on to that is when I started to adopt this mentality and also started to come to the realization that taking 1-to-1 trades is better than trying to aim for the 1-to-2, the 1-to-3. And this one is controversial to a lot of new traders because the parroted thing across the board is that 1-to-3 is the golden trade ratio. You should aim for 1-to-3 because then you only have to win 35% of your trade, whatever it is, 33% of your trades to make a profit. Dude, I don't want to win only 33% of the time, right? I don't know about you. For my personality, I've got to be winning a lot more than 33% of the time to make this work. If not anything but mentally, I need that higher win rate, right? Smacking 70 to 80% of my trades, take profit, take profit, take profit, take profit, and losing 3 2 to 3 times out of 10 trades, that works better for me than losing 7 times and winning 3 times, but then making those losses back. Okay, when I started to adapt this, at least for my trading personality, getting that one-to-one risk to reward over and over again has helped me to compound my accounts, build my confidence, and, pull it off consistently. And once I had my strategy formed and I got that data and I see, okay, now my current win rate's like between 70 and 80% depending on the month. And that has changed everything for me. So for me, that consistency of hitting those one-to-ones over and over has been more beneficial than the fantasy of trying to chase that 1 to 3 all the time, when the reality is it's hard to hit that 1 to 3 consistently. And losing as much as 7 out of 10 times is just not going to cut it for me, and I know it's not going to cut it for a lot of you guys out there as well. It's important to build those wins up and get that snowball effect going mentally. Remove this banana. Now, the next thing, let me tell you a story about this. I used to go for the biggest funded accounts always. Like, I used to go for the 150Ks. When I was trading with CFDs back in the day, I used to go for the biggest account sizes. The idea was, okay, these bigger account sizes, yes, they cost more, but I'm getting more drawdown to work with. Maybe this will help me keep the account longer and maybe get bigger payouts, right? That's the thinking. But I'll tell you what, I didn't get a single payout until I actually downsized my account, my funded account choice, from that biggest account size, not even to the middle account size, but to the smallest account size. Even to this day, now that I'm very confident in my trading ability, I can get funded with ease, I can take payouts with ease, I still trade the smaller funded accounts. Now, I've got a video on why this is important, and I will link that. This is relative to Top Step, but it applies to any funded prop firm out there. I'll link that down below, but just the gist of it is, the smaller funded accounts, number one, they're cheaper, they're more cost effective, right? Yes, you have less drawdown, but if you have a look at the profit to drawdown ratio, the profit to drawdown ratio is much more favorable in the smaller funded accounts. So they're actually easier to pass percentage wise. So you're getting to that funded account quicker. And then once you're in that funded account, focusing on getting that first payout to cover your costs and then be in the green as quick as possible was a turning point for overall profitability. Because a lot of people really tend to focus on, once they get to that funded account, okay, what's their stats? What's my risk to reward, my average profit, my average loss, all these things. They focus and nerd out on all these stats, building up their account balance and all this. They never actually take a payout. And they build their account balance, they never take the payout, they jerk off to their trading statistics, and then they blow the account without ever even taking a payout from that account. So yes, you could have some amazing killer stats in your funded account, but at the end of the day, if you're not withdrawing those profits, it doesn't mean anything. So for me, getting funded quicker by choosing those smaller account sizes, getting a payout quicker by taking a smaller payout initially, covering costs, and making a small profit from the get-go, made the bigger difference in my bank account at the end of the day. When you take into consideration dollars spent on combine and evaluation fees versus payouts that have come in, that was a tipping point for me where finally the bank account statement was starting to look green. And the thing is, with these smaller funded accounts, at least with the futures funded accounts, even if you're choosing the smallest account, once you get funded, you can scale it up and end up having basically the same parameters as the higher funded account sizes anyway. By taking a smarter approach with the smaller funded account sizes, I started to build up that consistency quicker, take payouts faster, and turn my overall P&L when it comes to the bank account green. Now, the second to last point here was taking a flexible approach to my trading strategy versus having a checklist trading strategy. And what I mean by that is a lot of newbies like to approach their trading strategy with a checklist ideology. So, I don't trade ICT anymore, but for example, it used to be like FVG at a certain time of day, check, market structure shift after the fair value gap, check, and then pull back to, what did he call it? Mean equilibrium, fair value, something equilibrium. I don't know the freaking word anymore, but it used to be, checklist these things and then enter the trade with a stop loss at swing low and take profit at opposing liquidity or something like that. It was a checklist strategy. The reason why a lot of newbies like this is because it takes a lot of responsibility off you, the trader, and then places it on the market or on the strategy or on the system. So that way, whether the trade wins or loses is fully dependent on this checklist strategy versus on your discretion as a trader. Now, you guys know that I repeat ad nauseum how important actually discretion is versus something like this. So a flexible framework simply means I have a framework, right, in which I view the market through. And then within this framework, and the framework basically is just the way that I interpret price, where I determine good prices to be, where I determine bad prices to be. And within that framework, I use my discretionary ability to execute within that framework. I dropped that rigid checklist, and instead I started to treat trading less like executing a recipe and more so like reading a language. Okay, so this doesn't mean necessarily trading on feel, but it means understanding the context of the market, understanding an intent of the participants, and adapting my approach based on these things. And the reason why this works better, in my opinion, than a rigid checklist is because the markets and market behavior is fluid. Okay, it's not a fixed thing that repeats every day, contrary to the popular belief of some trading influencers here with 1 million plus followers. It's not something that repeats every day. Market behavior is totally fluid, can be irrational, and is chaotic. So your system should be able to adapt to that. Your framework shouldn't be a rigid hold on the market. We are trying to enforce your will on the market. It should be something where you can view price through a certain framework and then execute within that using discretion and adapting to the conditions, to the setup that presents itself on the day. And the best way to incorporate this is to start to learn, no matter what strategy you trade, to start to incorporate some sort of order flow tool into your approach. And that could be market footprint, time and sales, a liquidity heat map. These types of tools can be incorporated into any strategy and will allow you to then incorporate this more flexible approach versus a rigid framework where you're just hitting that checklist and putting all of your responsibility on that checklist, versus placing the responsibility on yourself as a trader and reading and learning to read and adapt to order flow within your trading framework. Now, the last thing here, we can get rid of this big old glizzy now, is the last thing is incorporating volume profile. And again, this is something that's not strategy specific. My strategy is solely based on the volume profile because that's what I like. But no matter what strategy you trade, even if you trade ICT, okay, incorporating the volume profile to your trading approach, especially in the futures market, in my opinion, is one of the best things you can do to increase your edge and increase your ability at taking good trades. Volume profile taught me how to actually read the market, to see that auction process, to see the way participants are behaving in the market behind the candlesticks. Candlesticks don't do shit, okay? All these candlestick patterns in this doesn't really mean anything. They're not a great way to predict what's going to happen in the market, but by looking at the volume profile and seeing what's happening behind those candlesticks, what kind of transactions are occurring at different price levels, where the interest is, where there's no interest, where fair value is. And spoiler alert, fair value is not a fair value gap. It's nothing to do with it. Incorporating that volume profile, it basically is my edge. Okay, and once I wrap my head around using volume profile in the day-to-day markets, everything else got so clear. My trading reached a whole new height of accuracy and understanding. And it's actually one of the key reasons why my trading is so confident now, is because I understand the volume profile. I incorporate the volume profile into every single trading decision I make, and am able to execute with confidence. These 5 things here are responsible for what was essentially a launch pad in my personal trading career, going from being that loser to becoming a consistent winner. I still have losers, I still have losing days, but I'm so confident in my trading ability, and my bank account is proof of that, thanks to these changes here. So give yourself permission to evolve, okay? Don't feel trapped in the way you're trading now, in the certain things you may have picked up from cliches you've seen online. Be open to evolving and changing and trying new things, and trying maybe something on this list, even if it goes against what's considered conventional wisdom in the online trading world. You got to understand a lot of things that people repeat on social media and on YouTube here are just things they're repeating because they heard some other trading influencer say it, who heard it from some other trading influencer, from some trading influencer who might have pulled it out of his ass to make a video for clicks and views. I'm making this video for clicks and views, but I didn't pull these out of my ass. These are what helped me progress as a trader. And I hope you click this video a lot, and I hope you view this video a lot, and I hope you share it with your friends if you find this information helpful. And never trust randoms on the internet, but apply critical thinking to things like this and decide, hey, does this actually, if I throw away the conventional advice and the conventional cliches, would this actually work? Can this work? Maybe if I take this approach, will it improve my trading? Remember, 90% of traders fail, right? And 90% of traders also follow the same advice. Something to think about. Now, like and subscribe unless you want me to take your mum on a date. Goodbye.